big way was the US inflation data and the market meltdown that resulted off the back of that. The US markets went into free fall off the back of the US inflation data, which seems a bit strange given that inflation only ticked up by 1%. And look, I think diving into the detail of this one, and a word of warning that it is a little bit dense, but essentially there are different measures of inflation. There is a headline inflation number, which is the overall inflation, and that's the number that went up by 0.1% over the last week. But then there's another measure which is around underlying inflation. And what underlying inflation excludes is any items that have large price changes or change significantly over the reporting period. Now, it's the underlying inflation that has people worried in the US because that number rose at 0.6%, which compares to the estimated inflation that was 0.3%. So what that means is a couple of things. It's the fact that the inflation is still continuing to rise. And even though they have ratcheted up their interest rates significantly over the last little while, the fact that inflation is still rising means that there is still work to be done. Unlike in previous periods, there wasn't one big driver of the inflation number, with the exception of health insurance, which is up 24% in the US for the year, which is a pretty staggering number. But all of the things like rental costs, baby clothes, health insurance, alcohol, medical costs, they're all broadly up. And a lot of these items are what's considered sticky items where the demand is pretty constant, meaning that, you know, you need to buy clothes for your baby. So if the price goes up, you sort of pay that price. And that's inflation that's really difficult to dislodge. And as a result, now what they're expecting in the US is that there is going to be a further 1% interest rate rise at the next meeting, or at least the expectations of a 1% supersized rise have increased pretty considerably, which means that markets could be in for a fair bit of pain for some time to come. So now they're expecting that the terminal rate, so where the interest rates will eventually peak, will be above 4% in April next year. And it's leading some people to say that the talk of turnaround in interest rates, which is something that I was really hoping for, I think a lot of mortgage holders were, and a lot of business owners, and broadly in the economy, they're saying that that talk is potentially immature. But I do have to wonder, because I think that the reserve banks and the central banks around the world have shown us that they are prepared to step in when economic conditions start deteriorating, and that could potentially happen pretty quickly, and they'd be forced to step in, and then things turn around from there. Now, in Australia, this is a big problem for us because the RBA could be forced to follow suit. Essentially, when US interest rates are high relative to the Australian dollar, it means that our currency goes down in value, which makes it cheaper from people in the US and around the world to buy Australian stuff. And they call that imported inflation, where people, because they're paying much less in relative terms, they're prepared to pay more. And that drives our inflation up further. People are buying more stuff. That puts more money into businesses here, which has a further positive effect on inflation. So the RBA is nervous, and Aussies are nervous, I think, as a result. It sounds like some scary times ahead. I totally get that, but this is really where smart investors make money. So my suggestion on this one is to get on top of your game plan so that you've got total confidence to take maximum advantage straight away when and if things go further south. The next piece from last week was on the $3.8 trillion property market forecast mistake. And this is a piece based on some research that I put together and wrote for news.com.au, where I essentially found that at the start of the COVID pandemic, forecasters were predicting a 20% drop in Australian property, which, based on the value of Australian property at that point in time, was $7.71 trillion. What that would have meant is a drop in Australian property of over $1.54 trillion. But instead, what happened was, through to the end of 2021, the value of property actually increased to $9.95 trillion, reflecting a total increase of property of over $2 trillion, $2.2 trillion, in fact, reflecting a total forecasting error of $3.78 trillion, which is pretty massive. It's like 50% of the value of the property market at the time that forecast was made. So that leads me to question, how did they get it so wrong? And look, there are a lot of different factors that drive property prices. We've got supply and demand. We've got what's going on in the economy, housing affordability, the amount of new properties being built, what interest rates are, unemployment, household savings, inflation, all of these things. But what the data shows us, and I look back the data for decades and decades, and the single factor that has the strongest link to the movement in property prices is sentiment. And it seems a bit weird that our feelings are what's driving a $10 trillion wealth market. But the reality is our feelings can change pretty quickly. Now, at the start of COVID, many Aussies were fearful about what was going to happen, how things were going to play out. And in between our panic buying of toilet paper and hand sand, we were, sort of pretty occupied with thinking through all the negative things that could happen, and fear levels were quite high. But the world didn't end. The property market didn't crash, and in fact, it went in the opposite direction, with the property prices rising at the fastest pace on record to the end of 2021. So I think the lesson here is that the forecasters are often wrong. Over the years, I've heard a lot of predictions about this magical property crash that just never seems to happen. And in fact, we were working with a client just over the last week that called out, and good self-awareness on this, that they'd been waiting for the property market to crash for 20 years. And it just doesn't seem to happen. I think, in my view, good value properties that were good value 6 months ago, before this interest rate spiral that we're seeing at the moment, are good properties today. They'll be good properties 6 months from now, and they'll be good properties from 6 years from now as well. And I think, perhaps the forecasters will be right and the property market will soften further. But if you buy property today, it is possible that a year from now you look back and see that you could have got a better deal if you waited a bit, a couple of months, or you bought a couple of months sooner. But if the property forecasters are wrong again, then you'll be waiting, and all the time you missed out on the opportunity to make the smart property move. And in either way, I think that it's unlikely, if you buy and prices go down, that 10 years from now you'll be sitting there regretting that you bought a good property, because by then you would have made a boatload of money. But it is all important that you plan smart when you're buying property, particularly in the circumstances that we're seeing today. You need to make sure that you can comfortably afford the property, that you're not going to be forced to sell at a time that doesn't make sense, and at the same time you can live the lifestyle that you want today. And that means that your planning needs to be rock solid. It's something that you should do anytime you make any big investment, but we're seeing good properties holding their line. If you can make sure that that you're not forced to sell, even if the property market does soften further, you're still going to be set to hold property for long term and make money. I think in Australia, we love property, we love buying it, we love owning it, and we love talking about it. So everyone's got an opinion, but the reality is that nobody really knows. The key to making smart decisions and making money is to ignore that noise, to make sure that the plan is right for you, and then you're set to get the results that you want. Now, changing gears a little bit, one of the things that caught my eye in the news last week was around super funds essentially changing, or hiding, maybe hiding is the wrong word, but restructuring the way that fees are charged with some of their investment options to avoid some of the disclosure requirements. Essentially, super funds asking private equity providers to charge fees in different ways so they don't get captured under the APRA, who is the Australian Prudential Regulatory Authority, under their super disclosure rules, which sort of calls me into question, like, the whole point of this APRA oversight and the rules that were actually put in place specifically for super funds. Now, pretty much every big super fund in Australia, which covers millions of super fund members, has private equity options in their default fund. Basically, these funds have super strict fee policies, which were put in place to drive transparency for people that were, using super funds. And what can happen is that there are workarounds that mean that these fees don't need to get disclosed if people are doing things like charging performance-based fees instead of operating expenses. And I think the lesson here for super fund members is it's not always clear what it says on the tin. And overall, in my view, the private equity is a really unnecessary investment class that you don't really need access to make good money from your investments over time. But you want to understand what you've got, what's in your super fund, how it's all working, and ultimately vote with your feet and choose a fund that makes sense for you. Talking of people being a little bit dodgy, there were 13 investment fund providers that got a slap on the wrist or a talking to from ASIC for their advertising. Essentially, these funds manage up to $1.4 billion. And ASIC found that they were doing things like making apples for oranges comparisons, where they were comparing things like the return on cash against the return on shares, having inadequate investor warnings and downplaying risk. And ASIC have come out saying that investors are entitled to have access to accurate information, which of course makes a lot of sense. As a result, these 13 fund managers have updated their websites and marketing material and come out backpedaling in a bunch of statements about their investors. It tells me, though, that you need to really understand what you're investing in and don't just believe what you read. My tips around this to make sure that you're making smart decisions when you do invest and not falling for marketing hype is understand what your fund is investing in so that you can compare. Look at what your investment timeline is. And if you're comparing investment timelines, make sure that those timelines are consistent. Look at the fees and whether the returns that you're looking at on your fund are pre or post fees. And of course, and most importantly, make sure that you're making sure your investment fits with the other things that you're doing with your money, that it's not just a good investment in absolute terms, but it's going to be actually an investment that fits in with the other stuff that you've got going on in your life. Some sad news for younger Aussies on the next one, and the Aussie dream of home ownership is fading fast, particularly for young people and those on lower incomes. Data shows that home ownership is down 5% in Australia from its all-time highs, which we saw in the 60s. And 5% may not seem like a big number, but not all people are feeling this equally. So for people aged between 25 and 34, home ownership is down by a full third. And for those in this age bracket, that 25 to 34 age bracket, on lower incomes, home ownership rates have halved, which is scary, scary, scary. Now, basically amongst the poorest 40%, so the lowest income 40% of 45 to 54-year-olds, only 53% of people own their own homes today, which is down from 71% 4 decades ago. Given that housing accounts for 2/3 of the total wealth in Australia. So of all wealth, of everyone's investments, every single person in the country, 2/3 of that is locked in property. So the fact that fewer people are owning properties and that more properties are being owned by people with more wealth and higher income groups, this is a serious problem that leads to high levels of inequality and financial stress. So home ownership being concentrated with older and wealthier people means that people are getting priced out of the market, and it is really something that can make it unachievable. We're also seeing institutions move into the property space and residential property, again, making it even harder for people to get in. So some scary stats there. And I think that I put up a TikTok on this last week, and a lot of people were talking about the fact that they're sort of given up because it's all just too hard. But the scary part of that is that the longer you wait, the harder it gets again. And if you wait forever, and then you're never going to be in that position. So while it is hard and it's certainly not easy, I think that you need to push to make that happen so that you can be in the market and building that momentum. Keeping on the property theme, and I was looking last week at some data that shows that there's a bunch of suburbs where the gains that were realized through the pandemic have now been all but wiped out, with some suburbs being some like inner city suburbs in Sydney and around the country, like Redfern and Darlinghurst in Sydney, which are pretty solid from an investment perspective. They're essentially close to erasing all of the gains achieved from the pandemic as this market correction accelerates. Now, a company called Suburb Trends did an analysis about 300 housing markets and found that 12 statistical areas are facing the prospect of losing their short-term gains within 6 months, with a lot more to follow suit. These markets are dropping by around $60,000 a month, the average property price. So it won't take too long for those gains to be eliminated. So the top ones on the hit list here, we've got Port Phillip in Victoria, Leichhardt in New South Wales, Holdfast Bay in South Australia, North Canberra in the ACT, Kingston, Sydney Inner City, Maribyrnong in Victoria, Banyule, Darebin, Murunda, Moreland, and Darwin suburbs. All of these suburbs are set to have all of the pandemic gains wiped out within the next 6 months, and a lot of them within the next 3 months. There's a number that are in the next month or so as well. And I think that the stats overall, stats from CoreLogic show that the 2.7% of suburbs in Australia are now lower than before the pandemic. But even as prices fall, the fact that we have seen so much gains means that it's the prospect of negative equity on properties is unlikely. And negative equity is a bit of a problem because people owe more than the value of their property is worth, and that leads to financial stress. It means that people are essentially locked into the mortgage. Now, you lose that flexibility, and then you essentially trapped, and that's not good on a personal level. It can lead to bad long-term financial implications as well. Not all suburbs are feeling it the same, though, that there some of the markets, and particularly the ones that posted the biggest profits over the last couple of years, are likely to hold on to their pandemic profits longer as their property price falls remain more modest. Last one on property for this week, and national rental vacancy rates have just fallen to a decade rate low and pushing up rents around the country. The residential vacancy rate dropped to 0.9% across Australia in August, which is the lowest level of 16 years, with rental supply massively down and demand stronger than ever. SQM Research put out this data saying that the decline in available rental homes is likely to push rents up over the next few months as fewer properties are listed to lease. Sydney's vacancy rate is at 1.3%, where Melbourne is 1.4%, Brisbane is at 0.7%, and the other capitals are all below 1%, which is crazy low levels, and rents are up as a result. So Sydney, for example, their vacancy rate is 1.3%, but the change in asking rents for the year is up over 20%. Melbourne is 1.2%, but their rentals are up over 15% asking rents. And basically, all of these other markets like Brisbane, the asking rents are up over 20%. Adelaide is almost 20%. Perth and Canberra, Perth is about 15%. Canberra, Hobart, and Darwin all around 10%. So there's a heap of people out there that were looking to buy properties, but with this current market conditions that we're seeing, they're holding back either because they feel like they don't want to, or because they have to because they can't borrow. And because these people are cashed up, it drives up rent further. Good news for property investors, but not so good for renters in the short term. Guys, that's it from me for this week. Stay safe out there, and I'll catch you on the next one.